Good afternoon, everybody. Thanks for joining us for the second Unity session on bookkeeping. So I'm going to spend approximately half an hour plus questions to go through some concepts of mainly double entry bookkeeping today. It's generic to the concepts of bookkeeping, and the next session that we're going to do is session number 3. Will focus on the software package 0. So we'll get into the meat of using the software package from session 3. Recapping firstly on the first session that we had, where we talked mainly about the outcomes of the bookkeeping. Why do we do it? What are the main reports we're trying to achieve from bookkeeping, which is the profit and loss account and the balance sheet. And to recap on that, a few important takeaways are that the profit and loss report is a report based on a prescribed period of time. It's a performance report of the business, and the period of time is more normally dictated as the month and the cumulative financial year, or the annual period. So it's for a particular period of time, but you can choose whatever period of time you're interested in order to see the performance of the business. The balance sheet, by contrast, is a report that is a snapshot in time based on a fixed date. So normally when you're looking at accounts, you're looking at balance sheets, you're looking at the most recent date that the accounts or the bookkeeping is up to date by. So if we said that we have all the bookkeeping up to date by the end of April 2020, your profit and loss would be for the period of time beginning to end of April 2020, but your balance sheet would be based on 30th of April 2020, so a snapshot in time. Key differences there about the two reports. The other takeaway from last time is that unlike running your business from the bank balance and the bank account itself, the profit and loss report contains information within it, within the performance of the business, that is not necessarily reflected in the bank balance at the time. And one key aspect of the profit and loss report is the depreciation figure, which is an expense that is dripped into your profit and loss every month, which reflects the costs of fixed assets that you have previously purchased, and that those fixed assets are declining in value as they wear out to be replaced in the future, and therefore a proportion of the cost of those fixed assets is actually expensed every month into the profit and loss account. So that's a figure that will be reflected in the performance of your business, will reduce the profit of your business, but actually will not be reflected in the bank balance. And the counter to that is that initial purchase of a fixed asset is not reflected in your profit and loss report at all. It doesn't affect the performance of your business shown by the profit and loss report, but it does affect the balance sheet. And so when you buy a fixed asset with money from your bank account, you are actually shifting, you're reducing the bank balance, which is an asset on your bank sheet, and you're increasing the fixed asset, which is also an asset on your balance sheet. So you're not changing the net asset position of your balance sheet, but you're just shifting values from one part of the assets of the balance sheet to another. So these reports need to be considered in conjunction with the bank account and with any cash flow forecasts that you're making. But whilst the reports are very important, the balance sheet and the profit and loss, in order to really get a proper handle on the financial affairs of your business, they don't change the fact that cash is king, and ultimately your business is reliant on the fuel of your bank account in order to keep going. So Moving on now to session 2, where we're going to look at how the numbers actually come onto those reports in the first place and what we're doing with the transactions in order to actually compile these reports. And it is a process known as double entry bookkeeping. Now, when I woke up this morning, I woke up with a question in my mind. Is there such a thing as single entry bookkeeping? And to be honest, I expected the answer is no, but I've looked into it and actually there is. There is such a thing as single entry bookkeeping, and it is simply a case of listing in a cash book format the transactions that have taken place, which you would find from your bank statement. So it's just literally listing the bank statement transactions and then categorizing those transactions into different categories of income and different categories of cost or expense. And then further to that, having another list below that of entries that have not yet hit your bank account that you know are going to hit your bank account. So this could be bills that you've paid but have not yet shown on your bank account, or indeed bills that you've received that you've not yet even paid and therefore are not showing on your bank account. So there is such a thing as single entry bookkeeping, which helps to sort of define the title of double entry bookkeeping, which is what we're really interested in. Double entry bookkeeping brings much more information into scope, brings things into the right time periods, and produces a much more credible set of information with regards to the performance of your business. So, what is double entry bookkeeping? Well, double entry bookkeeping is basically the concept that each transaction, the value of each transaction is attributed with the same date to at least 2 accounts. And the values cancel each other out. So each account has a debits column and a credits column. It doesn't matter if you want to conceptualize that as a plus or a minus. If you just want to say that the account is, for example, electricity, and you have a plus or a minus number listed on that account, and every transaction that goes into the electricity account could be going in as a positive transaction, in other words, it's a cost to you, or as a negative transaction, in which case it's a credit to you based on that particular account. But when we teach bookkeeping, we tend to teach it in terms of splitting it into 2 columns, the left-hand column being the debit column, and the right-hand column being the credit column, the debit being the positive and the credit being the negative in this example. So when you have a very simple transaction, okay, it appears in 2 accounts. In one account, it appears in the debits column, and in the other account, it appears on the credits column. So if you horizontally add up the positive of the debit in one column with the negative of the credit in the other column, you would come back to 0. Okay, hence the name of the software package, 0. And that's where the words balance sheet come into as well. It balances at the end of the day. So that is the simplest form of double entry bookkeeping. And I'm going to give you a spoken example of this before we come on to have a look at the spreadsheet that I've done, which shows me the ledger example. So a very simple transaction would be on the 1st of June 2020, you have paid £10 in cash, okay, for some copier paper. The way you would account for that is that you would have perhaps a stationary expense account, or you might choose only to have a general expenses account rather than a specific stationary expense account. That's your choice. But the stationary expense account, you would debit that account by the £10, which means that the stationary account now has a positive value of £10. You have positively expensed £10 in your business. And you would credit the petty cash account by £10. And that would be balancing up to the fact that your petty cash is now reduced by the £10 cash that you have paid for that copier paper. The two added together, one is on a debit side, one is on a credit side, the two become zero. Okay, and what you're left behind with is balances on two accounts. You're left behind with a negative balance of £10 on your petty cash account and a positive balance of £10 on your stationary account. Now, of course, if you're thinking about how do you have a negative petty cash, how can you have negative cash? You could only have used that cash had there been a prior balance of £10 or more within your petty cash. So on a rolling basis, what you're actually seeing is a diminishing of the total balance of petty cash by the £10. Before we move on to the spreadsheet, I'm just going to talk through a slightly more complex scenario of this, which is one that I used in the example in the last bookkeeping session. And this brings it a little bit closer to home for property investors. On the 15th of June 2020, you are reconciling your bank account and you notice an entry in your bank account where your letting agent has paid you £450. And they have taken 10% commission from the rent before they've paid you. So in this case, you would be, from the bank account, you will be making that transaction into your accounts and you'll be crediting the rental income account by £500. That's the rent that was paid to the agent. You'd then be debiting the agent commissions account by £50, which is the amount that they have withheld before they've paid you. And you will be debiting as well the bank account by £450. So when you go along the line now, you can see that you have a £500 on the credit side in the rental income account. You have £50 on the debit side in the commissions account, and you have £450 on the debit side of the bank account. And you add the three together and you come back to zero at the end of the row. Okay, and what you're left behind with is three account entries. That's why I say it's a slightly more complex entry in this case. So you're left behind with a sales value of £500. Okay, you have a commissions expense of £50, and you have an improved bank balance of £450. Now, thinking that through, that starts to make you understand the importance of double entry bookkeeping and how it is translating a £450 receipt into your bank account with a £500 sales value. Okay, and suddenly you can start to see a picture emerging here that the profit and loss is actually determining exactly what your true sales value is, as opposed to a much simpler way of looking at it to say, I've received £450 into my bank account, therefore my bank account, my sales value must be only £450. We're actually looking at that £450 and saying, no, we need to extrapolate this. This is actually £500 of sales value because £50 was retained, and that's an expense as commission to the agent. Okay, so hopefully that is relatively straightforward. We're not here to try and make things too complicated for you. And what I'm going to do now is share the screen. I did send this spreadsheet to you all, so you may have printed it out or you may have it on your own screens, but hopefully you can see it all on this screen. Now, I've got the group chat open, so if anybody is struggling to see the screen, can they please come back to me? I can play about with the zoom and the magnification of the screen if need be. What do we see here? Well, this is quite an interesting depiction here, because this is a manual ledger. This represents something that you would have seen in a paper format long before the internet, in the years where all the bookkeeping was done with large, long, landscape-sized ledgers, a very sharp HB pencil or an H pencil, and a very good eraser, where people would be writing all the figures in and then using a calculator to add up all the columns and add up all the rows, and then working out where they've written the figure in wrong and then doing it again, or working out where they've done the adding up wrong and doing it again until everything balances, so that the end of each row becomes the 0, as we've spoken about, and the bottom of all of those columns, the total bottom of the column, as you go along the row, the total row, that also ends up at 0 as well. It used to be quite an arduous task, and was quite a skill, because of course those people who did it well didn't make mistakes, and they were able to balance their bookkeeping very quickly and then move on to the next page. Of course, it's all changed from here. But looking at this page, this is an Excel depiction of what that page may have looked like. It's not exact, and certainly if you went through some museums and look at them, you'll see that probably what you're seeing in front of you now would actually be spread across more than one ledger, more than one physical book that you write into. But nonetheless, this is a good way of understanding what is going on behind the scenes. So what we are actually looking at here is a reflection of the bank account. We can see that because if we have a look in this area here, you can see that all the figures, all the transactions that we've written down here are already showing in the bank account. So in this particular case, we might be in a situation where you haven't done it for a while, you've gone back to your bank statements, you've got to catch up, you're a few months behind. So everything that has happened is reflected in the bank account already, and you're just going through the bank account, updating your ledger in that way. So we're looking here at March 2019, and as you can see on the 1st of March, the £60 that was in the bank account was the payment that you made to the plumber for a gas safety certificate. Now, for those of you that may not have been watching last time or may have forgotten, you might immediately be getting confused, because you would say, well, hang on, if you paid the plumber, why is it under C for credit and not under D for debit? Because when I look at my statement, my bank statement, it would be showing as payment or as a debit on the bank statement. And you're absolutely right, it does. And the reason for that is because the bank statement is the bookkeeping of the bank. It's not your bookkeeping. So the bookkeeping of the bank is the opposite of your bookkeeping. Okay, so although the bank is saying is debit, and you have over time got to understand that a debit is a payment, in this case, your bank statement on your bookkeeping, it's the opposite way around. So the credit of £60 in your bank account, okay, your bookkeeping account called bank, is a credit of £60. Okay, so that's the easy one. That's the first thing you'd write with your sharp pencil, because you're taking that straight off the bank statement that is on the desk next to you. But then you've got to decide, what is that £60 for? And you know it's for the gas safety from invoices or records that you've got, or from the description on the bank account, on the bank statement. And therefore, we have an account here called repairs. So we're going to debit the repairs account with 60. So as you can see, the double entry here, the entry in your bank account as a credit of 60, the entry as a debit under the account called repairs. Okay, and if you add those two up, and if you had a control column at the end here, it would be 0. 60 debit minus 60 credit equals 0. So that's the first entry in March. The next thing that happens on the 5th of March is that you pay interest to your lender. Okay, and again, it's showing as a credit in the bank account of £350 interest. Okay, so you're putting that as a credit in your bank account, and you're putting that as a debit under your mortgage interest account. So if we just have a look at these greens here, these accounts that are breaking down the different expenses of your business. I have, for this simple example, used utilities, mortgage interest, repairs, professional fees, and other. But of course, you could have 15, 20, 30 different accounts here, depending on how detailed you want to see your business performance. So for example, where we've got utilities there, you could have 3 accounts there. You could have gas, electricity, and water. Okay, you might have another account after that called council tax. So you can have as many accounts as you like, and when you go into a software package of Xero, you'll start up a company and it will give you the general number of accounts that most businesses will have. But what you then do is you customize that by adding the accounts that you want. Okay, and that's very simple to do as well. Okay, now you can see along these accounts as well that I've color coded them, and if you're probably ahead of me looking down here, that the color coding actually dictates the different types of accounts. And the reason I call them different types of accounts is because these accounts appear in different places on your reports. So this blue is the income accounts that we have here. This rose color is the cost of sales accounts, which appear above the gross profit line. We had a question last time on the cost of sales and how do you determine whether an account should be a cost of sales account, whether you should attribute it to a cost of sales account or whether you should attribute it to an expenses account. And the simple rule of thumb with this is that if you sold nothing, okay, would that account be affected? Okay, so in the situation of agent's commission, if the agent's commission, if you didn't sell anything, then the agent wouldn't be able to take a percentage of anything. So if there was no rent, the percentage of Xero rent is 0, so they wouldn't take a commission. However, the utilities, the electricity bill, is going to be there whether you trade or not. Okay, so you're going to have to pay the utility bill regardless. So that is an expense of your business as opposed to a cost of sale. It's probably going through your mind that you could have a situation where you have a fixed monthly payment to your agent, which is agreed. And strictly speaking, that would then go into the expenses account because the fixed monthly payment to your agent has to be paid whether or not you have any rental income or not. So the proper manner of accounting for agent's commission, if it was fixed and monthly, would actually put it into the expenses and not put it into the cost of sales. So just working down, on the 10th of March, we had £800 of rent come in. But let's have a look. We've already covered this off earlier in this session. The bank account is actually saying £720. So The easy mistake to make is to go, oh, well, that's rental income, and therefore I'm going to put £720 in for rent. But of course, you know that you've got this agreement with the agent that takes 10% of the rent. You know that the rent that the tenant has paid was £800, and therefore it's very important that you put £800 in there, and you have that in the credit side, and we have £80 in the debit side of the agent commission, and £720 on the debit side of the bank. So working that across left to right, you can see that the balance of those three is 0. Okay, 800 credit, 80 debit, 720 debit. Okay, and you're left with 3 accounts being affected. So although it's double entry bookkeeping, in this case, and in many cases of, particularly if there was VAT involved, in the majority of cases, there will be more than 2 entries, more than 2 accounts get affected for every transaction. But whilst I mention VAT, whilst it's not normally applicable to landlords, it could certainly be applicable to developers, that whilst I mention VAT, it comes back to the real importance of that sales value being the amount, the true sales value that was paid over by, in this case, the tenants, because if that was the sales income of a normal trading business, a shop, for example, then it's the £800 that is subject to the VAT, even if there was a salesperson selling those goods and taking £80 and then putting the 720 into your bank account. Okay, so you would be wrongly accounting the VAT if you'd have put the £720 in to the sales column, and you would be underpaying VAT to the government. So there is some real importance in getting this correct. Carrying through, we've got gas and electric being paid. So on the 15th, we can see that there's £200 credit in the bank account, and we've put £200 on the debit column of utilities. We then have some repairs. We have £40 to the locksmith to replace some locks. So again, a very similar situation. £40 credit on your bank account, reflecting £40 in your repairs account. Another tenant pays rent of £600. The agent takes 60. So in your bank account, you see that there is £540. You know the agent's taken 60, perhaps from the statement that the agent has provided you with. So your income, your rental income is 600, and your agent commission is debited at 60. Okay. Just want to go to the left here and just remind us all that we are very interested in these dates, and we're showing you the dates of these transactions, what the transaction is, who it's for, and we're also showing you which account it affects and whether it affects the account as a debit or as a credit. Had I continued this line over 3 or 4 months, this is very important that we get the date right, because if we're going to do a profit and loss account for March, it's very important that we only look at the March transactions to get the correct monthly figures. I'm just going to give you one more example here, slightly unusual example where you see £50 has come into your bank account, so you debit your bank account £50, and you see that it's come from an electricity company. They have overcharged you in the past, and they've given you a refund of £50, and therefore you have credited your utilities with £50. So you can see normally you would have a debit of your utilities because that's an expense. You have a negative expense here, and you've credited your utilities with £50. Now, £50 has come into your bank account here. Okay, so here you had 720, here you have 540, and you put them into the sales account. But this £50 is not sales. This £50 is a credit against an expense, and it goes in there, and it would serve to reduce your utilities value for that month. Okay. And therefore, I go to the total line for the month, and I then add up the debits and the credits of all the accounts. Now, generally speaking, each account will have the vast majority, if not all of the transactions, in the same side. They will either have them on the credit side or they'll have them on the debit side. Okay, as you can see with rent, you've got 2 incoming rent transactions during the month, and they're both credits, so we add them together and the total for the month is £1,400. Okay, we have similarly 2 deductions there, 2 costs to the business, which are both debits, and the addition of the 2 is £140. The reason I put the electricity company credit example in is that here you can see the unusual situation, which does happen, where normally you debit the expense, you debit utilities with the £200 that you're paying every month to the utility company. But in this case, you also have a total of all the credits in that. So you have £200 debit total on that account, and you have a £50 credit total of that account. And therefore, it's important that below that we have a balance. Going back, the balance here is the same as the total, here too, but here now we have a balance of £150. So within that period of March, the cost of utilities to your business is £150, okay, because you have combined the £200 cost with the £50 credit within that account. Okay, and so on and so forth. It goes with mortgage interest, repairs, and your bank account here. Now with the bank account, I have actually, for the sake of understanding, I have actually put another column in here, which is the bank balance, which is a controlling column. You can always have a look at the bank balance against your actual bank statements, just to control that you've got all the right figures in there, because bookkeeping is always driven and controlled to, driven by and controlled to the bank account. Okay, and you can see that we for this example, we start the month with a £5,000 credit balance. You've got £5,000 of funds in the bank account, and then these are the effects of those transactions on those funds, and they will be directly related to the bank statement that you see. And so you've got a certain amount of debits on the bank account, you have a certain amount of credits on the bank account, and that is the balance that you're left with, which reflects the balance that is showing on your bank statement. Before moving on, I'd like to talk about petty cash. Petty cash is, from a bookkeeping point of view, exactly the same as a bank account. You might have more than one business bank account, and you might have 3 or 4 bank accounts, which is perfectly fine. You just basically just add another column and put the other bank account in, and just do each and every bank account. Okay, and petty cash is just yet another bank account. What you would generally do with petty cash is that you'd have a separate register, a separate spreadsheet, a separate piece of paper, however you want to do it, where you would be noting down the physical movements of the petty cash tin. So when you take money out of the petty cash tin, you'll be writing it down to say that you've taken that amount out and this is what it's for and everything else. So when you go to do your bookkeeping, you take that piece of paper out of the petty cash that you've been writing down on, and that piece of paper should look exactly the same as a bank statement, because that is the manner in which you would have written it down. So basically, you first of all use your bank statement to do your bookkeeping with the bank, and then you take your petty cash statement that you have created, okay, with the petty cash, as if you were the bank, and then you do the same for petty cash. Now, for the sake of this example, I have not put any petty cash transactions in the month, and so the balance at the beginning of the month for petty cash was 200, and the balance at the end of the month for petty cash remains at 200. So we've now done our bookkeeping, if you like, for the month. We've gone through all the transactions in the bank account, we've gone through all the transactions in the petty cash, which were none. We've attributed those transactions with double entries into each of the accounts. We've balanced, totaled the accounts and balanced the accounts. And the control here would be is if you added all the debits and minus all the credits across these columns here, you will end up with 0 as a control, and same here as a control, and same on every single line. It would control back to 0, hence the name of the software package, 0. Okay, so how does that then reflect itself in the reports that we want to do? Because back in the old days, we had to actually generate those reports ourselves by getting another piece of paper and adding up these accounts and actually writing them into the right, what I call address on each of the reports. Okay, so the template here is the descriptions, and then you've got the total values here. And I call these addresses because ultimately the balance of certain accounts always go into the same address on the reports, whether the report is profit and loss or whether the report is the balance sheet. So when we're having a look at this, we look at the sales, and we know that the sales account, the rent account, goes into the sales part of the profit and loss. And you can see that quite clearly there, color-coded with an arrow showing exactly that balance goes there. Okay, this balance of commissions goes there. Okay, we then on our report, we say, well, what's that minus, sorry, the sales minus the commissions, which is the cost of sale, and that gives us the gross profit. That's a formula, that's not an account. That hasn't come out of here, it's come out of the formula between those two there. And so on we go. I've kept it relatively straightforward and simple, where I've just literally reflected these descriptors here with these descriptors here. But it's quite common that you have more accounts up here than you have lines here. And you can see that I've got an other there. But you could have, for example, if we go to utilities, we could have an account here that's called electric. We could have an account that's called gas, and we could have an account that's called water. Okay, and they'd all have different figures in there, which would ultimately add up to the 150 that we've got there. But on our profit and loss, we might say, well, for our management, we don't actually need such a detailed breakdown. So all those 3 account balances are going to go into that address there. So you then just add up the 3 and you come to the 150 and you put the 150 in there. So you can have multiple accounts feeding in to particular lines on the reports. Okay, we carry on with the other green expense accounts here all the way down. I'm going to come back to depreciation later. That doesn't directly come out of the bookkeeping that you do with regard to the bank account in this manner. It's a separate exercise that you will do once a month. And then the report then gives you your net profit at the end of the day. But then you realize that actually we haven't used up all the accounts. We've only used up the accounts that these reports are demanding from their addresses. So what about the other accounts? Well, I can tell you that every single account has to reflect itself somewhere on the profit and loss and the balance sheet. Okay, so you'll never have an account that actually is not showing anything on the balance sheet unless the balance of that account is 0. Okay, so what we've got here, and remember we talked about, look at this period of time, profit and loss, period of time, beginning of March to end of March. Okay, the addition of all the transactions within that period of time. Balance sheet, snapshot, 31st of March. The balance sheet is as at 31st of March. So what we're looking here is we take the balance of the bank accounts and we put that balance onto that address there. Okay, the balance of the bank account, that's an asset, okay, and whatever was on that report before gets replaced by the new balance of the bank account on the 31st of March. Okay, so we've got that here, final entry here, 28th of March there. Okay, balance of the petty cash, there's not been any change in that since the previous month. So the previous month's report would have shown on the 28th of Feb, 29th of Feb this year, 28th of Feb, would have shown 200. Okay, there's been no transactions, there's been no change, it still reads 200. I'm going to come on to that in a minute. Okay, the accounts receivable. We did cover it off in terms of what it meant in the last session. I'm going to come back to that. Okay. Now, all the other figures are figures that have historically hit these assets because they are the balances of these accounts. So we've got a buildings account. It's not shown up here. I haven't put it on the ledger, but it exists. Okay. We haven't had any transactions here that influence the buildings accounts, which is why I haven't put it on there. So the balance of the buildings account hasn't changed from last month to this month. However, the balance of that account as a result of past transactions is £112,000, and that remains there on the balance sheet. So we're now taking the balances of all the accounts, even those that are not shown on this example spreadsheet, and we're applying them to these addresses. We are seeing on the balance of the furniture asset account that we have spent £6,000 3 years ago on furniture. So the balance of the furniture account is showing on the balance sheet as £6,000. We have run depreciation every month, and we have accumulated, since we bought that furniture 14 months ago, I can see it up here, okay, we've accumulated 1750 of depreciation, which has reduced our value of that asset on our balance sheet by 1750, and so the value of that furniture, the book value of that furniture, disregarding how much you would get for it on eBay, is £4,250. And that 1750 has dripped itself in over the past 14 months of profit and loss accounts as 125 in each month. Okay, and that gives us our total asset position, including the building, which costs £112,000, which, by the way, does not depreciate. Okay, but let's leave that for a more advanced session. The £112,000 gives total assets of £118,000. Okay. We then have accounts payable, which I'm going to come on to before we end this session. We're going to talk about both accounts receivable and accounts payable. Okay. We then have historical transactions, which are still showing in the balances of accounts which have not transacted in this month. Okay. We have a loan of £84,000, which we borrowed in order to buy the building with from the bank. Okay. We've been paying interest on that loan. Okay, there it is. But it's an interest-only loan, so it's retained its value of a liability of £84,000. And when we first started the business, we introduced £30,000 of our own money in order to get that business going and pay down the deposit on the property. So that was a loan that is an asset to the individual, the personal asset to the individual, because they are owed that money. But the company here, it's a liability because they owe the money to the individual. even though the individual might be the owner of the company. So £30,000 is owed by the company to the individual, to the director, as a director's loan, and that is a liability to the company. Okay, so your total liabilities there, £114,000, and your net assets, the book worth of your business, not necessarily the amount you sell your business for, but the book worth of your business is 3,910. Okay, and that book worth is representing the performance, the historical performance of your profit and loss. Okay, so as your profit and loss keeps making more and more net profit, it keeps feeding in to the net assets. Okay, how does it feed into the net assets? Because the net profit is going into the bank account, which is increasing your bank account balance here. So I'm going to move on with one more concept on all of this, and then we're going to take some questions. What is accounts receivable and what is accounts payable? Ultimately, what you can see here is your bank account, okay, and your bank account is the transactions that have been received by your bank or paid out by your bank and are reflected on your bank statement. The bank drives bookkeeping and the bank controls bookkeeping, okay? But there are always transactions that have happened that have not yet been reflected in the bank account, and that works on both sides of the equation, okay? So we've got the accounts receivable is sales that you're yet to see in your bank account. Okay, so this might be a tenant that's late with his rent. Quick brackets there. Generally speaking, most landlords won't account for rent until it's actually paid by the tenant. But it would not be wrong to do so. You can account for rent that is due and not paid if you wish. Okay, and if you did that, then that would be a good example of an accounts receivable. You know that the tenant is due to pay £300. If you were a trading business, it could be an invoice that you have issued. You've written an invoice, you've emailed the invoice, and you're waiting for payment of that invoice. In the old days of how payment worked, you may have received a check in the post. Okay, but you've not yet put that check in the bank account, okay? Or you have been to the bank account and that check actually then cleared in the next month, okay? All of those scenarios would mean that that £300 is money that you know you're going to get, money that your business is due, okay? Money that would be reflected in your performance here as sales, but is not yet in your bank account. And conversely, accounts payable is, which is normally the higher figure of the two in many businesses, is the money that you owe. So these are all the invoices that you've been emailed, that you've received through the post, that you've got on your pile, waiting to pay, okay? Or indeed, it could be invoices that you have literally just paid, but they're not showing in your bank account yet, or they're invoices that you did pay, but we're dealing with March, okay, and that invoice didn't actually show in your bank account or reflect in your bank account until April. So we've got three scenarios of accounts payable and accounts receivable here, and they basically all mean it's not yet in the bank, or it's not reflected in the bank for the period that you're looking for. Okay, so I just want to talk a little bit more about accounts payable and accounts receivable with regard to bookkeeping, because what we don't have up here is an account here called accounts payable or an account called accounts receivable, but actually they exist. So when you go into your bookkeeping, you will have an accounts payable account. Okay, so let's just have a look at that over here. Okay, so 28th of March, gas safety certificate, plumber, okay, you've got the invoice, you know it needs to go into your accounting because it's dated the 28th of March, okay, and therefore you need to put it into your account, your March accounting, okay. It's not in your bank, okay. It's not in the petty cash. You don't see any record of it in your bank, but you do have the invoice. And you know that you need to pay that invoice, okay. You may know that you've paid the invoice, but you paid it on the 28th of March, and you know that it hit your bank here on the 12th of April, okay? So you're only considering March at this stage. So what you do in the bookkeeping to deal with that interim period of time, you can't account for it against your bank account because then your bank account would not reconcile to your bank statement. So you say that that is a debit on your repairs and a credit on your accounts payable. Okay, and that is the journal entry that is made, and that is made automatically by the Xero system when you enter invoices rather than coding directly from the bank account. You enter the invoice and it says, okay, that's going to affect the repairs account and that is going to affect the accounts payable account. Okay. Come April, the bank account then reflects that £60 going out. So from your bank statement, you enter that £60, okay? You're looking at your bank statement, you say, oh yeah, that's £60, that's the plumber. Okay, that's the £60 for the plumber. So I need to put that in as a credit in my bank account. Should I put it in as repairs? Oops, just a second. No, because last month I put it in as repairs last month. So if I put it in as repairs again, it's going to mean that I'm double counting, that I've got 120 in my repairs bill over the 2 months when I should only have 60 in my repairs account. So where does it go? It's in the bank account. It can't go against repairs. I know what it was. It goes against accounts payable. That's what it went to before. It went to accounts payable. So we now credit the bank account with the 60 that's received, and we debit the accounts payable account. The accounts payable account is a balance sheet account, not a profit and loss account. It's a continual account where the balance of that account is shown as a snapshot in time, and therefore what we can see on the snapshot at the end of March is the accounts payable account is showing £60. That's telling you that your business owes £60 as at the end of March. Okay. Then, when we come to the end of April, we can see that that £60 has now been paid. It's been reflected in your bank account, and so your accounts payable would be zero if there were no other influences on it during the course of the month. So this accounts payable account is a moving account all the time, where the invoices that you are paying are being accounted to accounts payable, and as those are reflected in the bank account, they are being negated on the other side of accounts payable. So at any time when you hit your balance sheet snapshot, the balance of many, many entries on both sides of this accounts payable tells you exactly how much money your company owes to its creditors. I'm going to go back. I'm going to show you that here. Okay, so we've got the accounts payable here. So when you're looking at somebody's balance sheet, okay, if you can see a big figure there, creditors, loans, directors' loans, this is money this business owes. Okay, so it's all very well to see that you're going to buy or take on a business from somebody else, which has got some great trading profits and some fantastic service accommodation and everything else, but ultimately you've got to pay what it owes. So that's why you need to take a look at the balance sheet and you need to say, well, what has it got and what does it owe? okay? Because ultimately, for your accounts payable, you need cash, okay? So if you ain't got the cash in the bank account in order to deal with the accounts payable, then you've got a bit of a balancing exercise to do as income comes in the future in order to deal with those invoices that need to go out. That's everything I planned to say, and I'm going to stop the share now, and I'm going to have a quick look at the chat to see what we've got here. So I own, this is Anil, I own HMOs and have a spreadsheet to manage the rents and the expenses, etc. It's a little nightmare, yes, I know. I've done that too now for 3 years. And there are so many rooms within the HMOs. So do you recommend any software or any spreadsheet template that's easier for HMO transactions? And thanks. Well, I don't recommend any spreadsheets, to be honest. If you've got a spreadsheet, then you probably are as best as you're going to get with that, because there's no point in learning somebody else's spreadsheets when you can do so much better by learning the Xero package. Or, I mean, I'm only going through the Xero package because that's a package I understand. It's a package I know, and I know it works very well for landlords and property investors. But quite frankly, you know, Sage, QuickBooks, there are more. You know, any of those packages out there are going to do the job. It's one of those cases that, you know, you plumb for one, and then once you're with it, you're likely to stick with it because you're going to learn that, and you don't want to then go back to the beginning and learn another one. So if you want to continue with the sessions that I'm going to do twice a week, then I would recommend that you use Xero, because that's the one I'm going to be talking about. But by all means, I'm not on any commission from Xero. You have to look at the cost implications of using different software packages. Xero works for me, and I think it's a very good package personally. So that's that. And in terms of translating your current spreadsheet into Xero, you're probably going to need a bit of help. So you can talk to me a little bit about that, but you're going to need to have some opening balances put into Xero initially, because when we looked at those, for example, the bank balances, the accounts payable balances, the accounts receivable balances, the buildings, the loans, all of those balance sheet items, those balance sheet accounts are going to need to be populated with an opening balance, so that when you then start to code your transactions from the bank account thereafter, you're going to end up with the correct figures on your accounts from that point of view. So the next one is, how do you reflect CapEx, capital expenditure versus revenue expenditure in your bookkeeping when the items might fall into both categories under one account code? E.g., installation of a new bathroom plumbing work versus RevEx, which is that revenue expenditure, bathroom plumbing repairs. Well, actually, that's relatively straightforward. So what you're actually saying is that, well, I'm not quite sure what you're saying there. You could be saying two things there. You could be saying that either this cost that has gone into my bank account from my plumber is repairs, or it's capital. Okay, that could be one thing that you're saying, and it's an either-or situation, and that would be a very simple answer. Yeah, if it's repairs, you put it into the repairs account. I'll share the screen once more. If it's repairs, you just put the total value from the bank that you paid your plumber, and you just put it into the repairs account. Simple as that. If it is capital expenditure, then you would have a specific capital expenditure account for that. It could be a buildings account, it could be a refurbishments account. You could have different categories of capital expenditures. Fittings, perhaps, fixtures and fittings wouldn't be a bad account to have for that. And if the total value goes into the fixtures and fittings account, then somewhere over here you'd have that account and you'd just put it in there instead of putting it into the repairs account. What the effect would be on your things is that instead of being here, as it would be if it was repairs, it would end up being here as fixed assets. Okay? You could have buildings, you could have fixtures and fittings in here, for example, and it would be there. If your question is, well, the plumber's invoice is a bit of both, if the plumber's invoice is a bit of both, I'm trying to think of an example here. He does a new bathroom. Previously, the bathroom didn't have a shower in it, it just had a bathtub. So in the corner of the bathroom, he's put a brand new shower that's never been there before. Okay, so arguably the brand new shower would be capital expenditure. Okay, but the tiling and everything else he'd done in the bathroom is a replacement, it's a repair to the property. So you would then have to determine from his invoice what values go into each. You have to make that decision, make a note on the invoice in pen or something that actually backs up that decision that you've made, and then that drives your accounting, that you can then say, okay, well, I'm putting so much in as repairs, and you could do this split accounting as we saw with the rent here, you know, that you'd have maybe a value in the credit of your bank, okay, of which some of that value goes into repairs and the balance of that value would go into the fixtures and fittings account as far as that's concerned. A £1,000 invoice for a bathroom could only be one or the other, surely? No. As I've just explained, the £1,000 invoice could be either or, because the accounting rules are such that the fixtures and fittings, the asset value, is new to the building, and that anything that is not new to the building as a replacement as such would have to go in as a repair, as far as that's concerned. I mean, from a point of view of how that affects your tax bill, actually you want it as a repair because that reduces your profit and therefore reduces your tax bill. Okay, so it's actually the other way around, that the Inland Revenue will say, no, you can't have it all as a repair because you never had a shower before to repair, so I'm going to attribute part of that £1,000 to the fixed asset, as far as that's concerned. Okay, so I've covered the questions that are there. If anybody else has any other questions, then please let me know. We'll just give a few minutes before I end now by saying if anybody would like to bring themselves into the room, make any comments or ask any questions, then please do so now. Okay, I've got a question that's come through from Ro here. You've covered depreciation. How do you account for appreciation? Well, generally, Ro, this is one for the accountant. You don't is the answer. In bookkeeping terms, in your monthly bookkeeping that you do, you will not ever account for appreciation of a building. That's the value increase in the building. There are certain tax rules which state that the accountant does need from time to time, and I'm not sure if it's once every 5 years. I don't know, if I'm honest, and I'd be guessing. But there are rules where the accountant does have to do a sanity check on the value of your property and actually put that in your annual accounts. Okay, and then the building's value may increase as a result of what your accountant does from that point of view. From memory, there was where there's some level of choice involved in that. From memory, the answer was, well, you can do it, but if you do it once, you've got to do it every year, and you've got to back it up with some form of valuation. So I'm sorry, I'm going to have to defer to the accountant on that, but the strict answer from a bookkeeping point of view is you leave it well alone. Okay. Anything else from anybody? That's good. I'm going to be putting this video up on YouTube, which will be a privately accessed video. The email addresses of all the members will be on this video, will be attributed to this video. So if you are logged into YouTube, then you will get access to this video because your email address has already been attributed to this video. However, I need to attribute your YouTube login email address. So if the email address I currently have for you is not your YouTube login email address, I would like you to send your YouTube login email address to me, please, and then I can make sure the right email address is attributed to this video, which will unlock the video and enable you to see it. Okay, I've got a question here with Ro. I was wondering how it gets recorded in the bookkeeping, even if it's done by the accountant. You're challenging me there. It would be certainly the one side of it would be the same side as when you bought the building in the first place, so that'd be quite simple. That would be the building account entry would be adjusted. There would need to be another account, a value adjustment account, to show it on the other side. Yeah, guessing at this stage, but it's a good question. It's nice to challenge me because I'll go away and find the answer and come back to you. Okay, that seems to be it. It appears there's no one else wanting to ask any questions, so thanks for your time.